Oil prices continue to plunge today despite the beheading of another Western hostage by the Islamic State. There have been a lot of tensions between Russia and the West and mayhem in Libya. One of the main reasons is surging U.S. oil production, which has made up for supply disruption almost barrel for barrel. And it is also a bad sign for the leaders of petrostates. Now, we have an estimate of where oil prices might have been absent the American oil boom. A sobering $150 a barrel. That's 55% higher than the current benchmark price of $96.27 that was trading in Asia. If my analysis is right, it means that the U.S. boom is saving the global economy about $4.9 billion a day in oil spending. However, global consumers currently demand about 92 million barrels of oil a day. And without the extra U.S. supply, the market would be about 3 million barrels short, sufficient to send traders into a frenzy, beating up the price. Since 2011, U.S. oil production has soared about 3 million barrels a day to about 8.5 million barrels, thanks mostly to the technique of hydraulic fracturing in shale oil fields. That is just a bit less than the volume of oil production that had been or has been persistently offline since the 2011 Arab Spring ushered in the 3-year wave of unusual oil disruptions that the world had experienced. When you add in a million barrel a day rise in Canadian oil production in the same time period, North America as a whole, as a region, has swamped the lost barrels. There is a warning that we should be careful and read that Western sanctions on Russia, where he made some of his biggest, where we have made some of our biggest bets with BP, could ultimately backfire and send prices racing back up. The ultimate cost and benefits of fracking are about much more complicated of a question. And with this thought, I'll leave you. Thank you.